Paul, we heard a host of voices there talking about various themes, that some of them coming back to the bond markets, and certainly today's focus for global markets seems to be about what is happening in the bond markets. Yields are higher. We see that now in Europe. We're waiting to see what happens with the gilt market when it opens. We can't move for headlines around what's going on the JGB market this morning. What are you seeing in global bond markets? How concerning does this look?
Yeah, good morning, Anna. I think in isolation, or if you're looking at it in the round, not that concerning at all. If you look at an index of returns on global bonds so far this year, it's about flat. It hasn't really gone anywhere. Corporate bonds have been performing strongly, and shorter maturity bonds have been hanging in there okay. But it's the back end of the yield curve where all those problems are, and those are the bonds that are most susceptible to inflation, and those are rising all around the world, particularly today because we've got another push up in oil prices, which of course spills over into the inflation outlook. Plus, we had figures from Japan. The PPI numbers were extremely high. We had the US CPI data earlier in the week. That was also on the heavy side. So people starting to get worried about how elevated inflation is going to be, what central banks are going to need to do to keep that under control. And that's been causing losses at the back end of the yield curve and pushing up those long-term borrowing costs for governments and for corporations.
Paul, are equities down because yields are up, or is it the fact that we just had a great run?
I think that there's definitely a sense of both of those two things, Guy. You can certainly make an argument that a couple of the reasons why higher bond yields might be unfavorable to equities. One, people have been leaning into stocks for so long. Why would you want to own bonds? Maybe would be the flip side of that. But the higher yields mean higher borrowing costs, mean higher costs right across the economy. So that at some point does turn into more of a negative for the stock market. But I think that, we have had that good run. I think there's a little bit of disappointment in the air over the Trump-Xi meeting. I don't think that a great deal of positive takeaways for the market there. We still got the war going on in the Middle East. Okay, you might think that hasn't been such a big element, but it is definitely, still pushing up costs in the economy through those oil prices. No sign of resolution into another weekend here.
A strong day for the dollar, Paul. What's driving dollar strength today?
Yeah, so I think that it's all part of the same story, more or less. People like the dollar as a haven and a risk-off asset. People like the dollar with higher oil prices because the US is a net producer. And people like higher treasury yields as another sign of sort of a tailwind for the dollar as well. So the market has moved more in favor of the idea that the Fed is going to be hiking interest rates at some point, and rather than cutting interest rates, because it's going to have to because of those inflationary risks in the economy. So that's pushed up the short-term yields, and it's pushed up the money markets as well. Spills back over into the dollar on a relative yield basis. People find it a little bit more attractive. But I think that, on the flip side of that, look at the biggest decliners in the currency market. It's all of those commodity currencies like the Australian dollar, South African rand that had such a good run as well. So that's getting a little bit of a puncturing as people take some risk off the table into the weekend.